Hello everyone, my name is Aziz. I'll be analyzing a property. So, I have a client who has between 100 to 150 million naira to invest. So, the property he wants to invest in is a rental property that he is not so sure how much he's going to make back in return. So, he's looking to Lagos State and different areas or different markets in Lagos where you can make a good return on investment over a period of 15 years. So one of the areas we are looking to is Satellite Town. Satellite Town is a very good location around Festac. So let's check Satellite Satellite Town. This is Satellite Town. Satellite Town in Lagos is in ward of in Lagos State government. Is in Lagos State, very close to Festac along Lagos Badagry Expressway. You can check your map. This is where Satellite Town is in Lagos State. So this is Satellite Town along Lagos Badagry Expressway. It's close to Kikri, ward of name Festac Town, Alaba and likes. So Surulere, Ijegun, that's the local continuing the LCD this thing, but I think Satellite Town is in Ojo local government, or I'm ward of it. So that's that about Satellite Town. That's just basic this thing about Satellite Town. If you want more information about Satellite Town, you can do your search. So we are looking at a number of properties, but we are going to be looking at this particular one. I'm clicking on Satellite Town. It's a 3-bedroom apartment. The owner is calling it 150 million naira. That's how many blocks of that's 4 numbers of 2-bedroom, 4 numbers of mini flat, and that's a space for for penthouse. And this is it. This is the picture of the property. So I don't really think it needs, from outside it doesn't look like something that needs much renovation. So, but basically you will see all of those things when we start our analysis. So this is the property, like I said, that you've seen is on a 600 square meter of land. It has what's it called? It's on a 600 square meter of land. It has 4 units of 2-bedroom, 4 units of mini flat. Self-contained. That's your full. These are its features: balcony, washing machine. All these things are not necessarily true. So it was listed on 27th, that's like about 2 weeks ago, and the listing price is 150 million naira. It's probably negotiable. So when we are doing our analysis, we want to look at how much they are renting property out in those areas. So say for example, this is Selfcon in Amawodofin. This is in Abule-Ado, Satellite Town. Selfcon is going for 900,000 naira. This one is Odofin. Odofin is also 700, 900. Mini flats there 1.5, 1.4. 2-bed is going for 1.7, 1.5, some 2.5. I think it depends on the amenities that is inside the apartment. 3-bed is going for like 4 million, and 4-bed 7 million, depending. So depending on the amenities that is inside the apartment, that will determine, and also the location of the apartment, that will determine how much you can demand for in rent. So let's go to our model. This is our model. We would assume the unit rent. These are unit rents. We have like 4 units of mini flat. Where a mini flat, we would assume that mini flat will go for 1.2 million naira conservatively, obviously, and we have our 4 units. So we have 2-bedroom. This is like 2-bed. This is like 4 units. This is like mini flat. This is mini flat. This is 2-bed. 4. This is 8 million. 8 million. If we have like 4 units of what's it called 1.2 million naira times 4, that should be like around 4.8. 4.8 plus 8 million. That's like 12.6 million. 12.8 million naira in total. And we have like our assessed value. Assessed value is like 75% of your gross rent. These are gross rent, 12.8 million. Our replacement cost, there's a way we calculate replacement cost. This is our replacement cost. We have like our so these are the income things that come in, the amount of money that comes in excluding this replacement cost. For example, So excluding the replacement costs, these are the incomings, like the money that coming basically is just the rent, and we have our gross rent. So if not even calculated our net rent yet. So we have like what are the deductibles, the things that we are going to be deducting. We have like our outgoings, we have our taxes, we have taxes is making 5% of your assessed value. No, sorry, I'm coming. So yeah, 5% of our assessed value. We have our repairs. We just and code them. We don't necessarily have like a number of this thing for repair. We have like insurance. We have management. Management is 5%. So we have our cap rate. Don't necessarily need to worry yourself about this much. We have our purchase price. Purchase price is 150 million. We got that here. 150 million naira. That's what they put on there on the this thing. This is it here. 150 million naira. It's probably negotiable. 150 million naira. We have let me go back to the model. We have our closing cost 160. Total purchasing price is 160 million. Equity contribution is 70 million naira. Total equity investment is 172 million naira. That's total equity investment, because this 2.4 million naira comes from renovation at purchase. That's like 2% of our replacement cost. That's our renovation at purchase. Like that's just like assumption. It's not like as if it is a fact. It's until when you get it out, you will know whether or not it is, whether it is more or less. You might decide not to even renovate from, because from the picture I'm seeing, maybe you do some internal innovation, not external innovation. So so there are two ways to fund this project. Is either you do pure capital, like pure you using all your money to fund it, or you go through federal government, or you use mortgage. The mortgage that we'll be using here is the federal government mortgage scheme, which is like MWIF. MWIF stands for the Ministry of Finance Incorporated, something financing. I can't remember the E, but the F stands for finance. Right, is the Ministry of Finance, Incorporated. So what MWIF gives you like 9.75% of like annually, and you can only get up to 100 million naira. Anything above 100 million naira, you can get it. So the total equity contribution, how much you'll be dropping is like your 70 million naira. That's like 60 million, 50 million naira from this purchasing price, plus 10 million naira of closing cost, plus 10 million naira that you'll be dropping because you have to contribute 10%. Like this is it, 50 million naira that is on this, because you can only get 100 million naira. So 50 million naira on this, plus 10 million naira closing cost, plus 10 million naira of what's it called, equity contribution for the loan. So that means you'll be dropping like, yeah, this is 70 million naira plus 2.4 that you are going to be using. That's the renovation as purchase. All these things is like 72.4 million naira that you'll be dropping for the what's that you contribute, like your initial deposit, your money that is going to come from your hand, and you'll be getting 90 million naira in what's it called, in loan. Interest rate is 9.75. I would assume it's like 15 years that you pay back. So this is our growth rate, what we calculated as growth rate, exit cap rate, and this is what we assume that you sell the property back at 15 years after your what's it called, your at when you go, considering the growth rate that we use, annual growth rates, annual rate of growth rates, I mean everything. Basically, this is what we determine. I would assume 6% of this will be the price, the cost of what's it called, of the sale, which is like your legals and what's it called, legal and what's this thing called, your legal and your agency fee. That's like 6%, would I assume. So on all of these things, we've now done our calculation. This is our gross rent, right? This is our gross revenue, gross rental revenue, our gross rent. It goes 8%. So if you calculate it, you realize that this thing is growing 8% annually till 37.5 million at the end of your 15-year what's it called, tenure. So sorry please. There is a mistake here. I should have done one, two. Three. Why is this thing doing actions like this? This thing should do normal now. Let me just encode it there. 4, 5, 6. This thing should do 7, 8, 9. So this is 15 years. Like it takes 15 years to do this. What's it called? The what's it called? This is 15 years. So these are our gross rental revenue for 15 years. We are going to deduct these three things. We are going to deduct taxes. We are going to deduct repairs. We are going to deduct insurance. So every year, and we have our net rent. This is what we would assume our net rent based on our calculation. And at the end of yeah, what's it called? This is our unleveraged cash flow. It's not levered. It's unleveraged cash flow. This is our unleveraged cash flow, which is basically our net rent. But here we have our net rent plus our what's it called? Our net rent plus our what's it called? Cost of sale at year 15. So this is what we'll be getting at the end of year 15. Would assume this is what we'll be getting, and for loan, we already have our net income. So we are going to deduct loan. This is the loan that goes into interest, that goes to principal, and this is what we have as our loan balance till the end of the year. So this is what we'll be having for so from this property it looks like, as from the beginning of the of our investment, would we won't be paying, because most of the properties you maybe till like year 5 you'll be paying loan, but from this property it doesn't look like we'll be paying loan till the end of the year, till the end of our investments. Like from day one, you are not using you are not paying part from your distance, because you've actually paid a substantial amount of money. That's like around 72 million naira from the beginning of the investment. So in essence, you are not going to be paying any money. So right from day one of your investment, that's if you use MRIF, you should be making enough money. You should be making money off this thing. So the rent itself will be paying the mortgage, and you'll be fine. So that is basically what we are having here. And so this is what we expect. So our IRR is like, IRR means internal rate of returns. So we have 14 if we are using unleveraged. That's if we are using all cash. We have 16% if we are using leveraged. Our yield 12% if you are using this thing. Because one of the reasons the yield is lower is because using higher on unleveraged is because we are not giving any money. All the money comes to us. All the money. Your net rent, you keep everything. But when it comes to what's it called, to leverage, it's not all the net money that is coming to you. Majority of it is going to what's it called, to the bank. The reason, so, but the only place where you make majority of your money, because you're only contributing like 72 million naira to get what's it called, 411 million naira, and with all others that you are making here. But yeah, you are dropping 150 something million naira, 150 million naira, or even 160 million naira to get this 423 million naira. So that is what your yield as unleveraged will be higher than that of leverage. Our cash multiples is like, for every 1 naira that you drop, if you are using all cash, you are the one dropping all the money, you get 4 naira 49 kobo back. But if you are using loan, you get 7 naira, 35 naira back. So that is basically the calculations. So if you have any question, you can drop in the comments below. I will definitely respond. Thank you very much and have a nice day.